Biztech's Investors Conversation Show. Our guest today is Murli Ravi, the co-founder of Tin Man Capital. Tin Man Capital is headquartered in Singapore and is a firm that exclusively focuses on B2B tech startups with Southeast Asia as their primary market of interest. Now, to tell us more, welcome to the show, Murli.
Thanks, Brian.
Now, Murli, for a start, tell us about Tin Man Capital and why you started the business.
Sure. So my partner, Jeremy, and I, we've been in investments for a long time. I've been doing venture capital investing since 2008, right? So since the previous financial crisis. And Jeremy similarly has been doing both sell side, meaning working for investment banks, doing IPO, M&A, those kinds of things, as well as buy side, similar to me, in primarily B2B focused industries. And my portfolio, when I was doing venture capital at a previous firm, coincidentally happened to be all B2B as well. So that's our background. And then we looked around when we first decided that we want to find something of our own, build something of our own. What is the market out there? What is the need in the market? Can we fulfill it? And so on. And we came to a very quick conclusion. The skills that we bring and the relationships, the network, the past history, and so on, versus the gap in the market, which was basically a lot of money going towards B2C and very little to B2B tech. It made very obvious that we could fulfill that need in our own little way. We're not saying that we are going to be the sole parties out there. I think we are humble enough to recognize that it takes, many more people than just, one firm. But we thought we could do our part.
And that's an interesting conclusion that you came up to, because that's really, even today in 2022, the gap in the market. Now, you started your firm in 2018 because the money has gone into either e-commerce or consumer-focused startups. And so B2B serving industrial companies and stuff perhaps is not as sexy, but then I think in terms of returns and stability of revenue, those are probably a lot more sustainable. But tell us a little bit about the B2B landscape in Southeast Asia right now in terms of enterprise startup and technology.
Sure. I think the core to start with is, and I always advise entrepreneurs the same thing, start with the customer first, right? We have seen that B2B technology has been adopted increasingly by some of the legacy industries who perhaps were not the most forward-thinking or technology adoption in the past. So why has that changed? For at least a couple of reasons. Reason number one is, this is even pre-COVID, people were using technology in their personal lives. So consumer, things that we've talked about, right? And at some point, I think the light bulb has started to go off in people's heads. Look, if I'm using this in my personal life, my kids use it and so on, why is my business still run on a piece of paper or using legacy technology, right? So that's point number one. Point number two is there's been a little bit of a handover, and you're from Southeast Asia, I'm from Southeast Asia. We know some of these largest companies in the region, even though they might be listed, are actually family owned. And the baton has been passing to the next generation over the past few years, right? So when new blood comes to the fore, very often, either the parent or the new blood coming in, they're basically saying, look, let's see what we can do to remake the business. And technology is a big element of that, right? A third is, these are all, when we look at the industries that we are focused on, these are heavy asset or heavy industry, right? By and large. So logistics, shipping, agriculture, construction, travel, so on and so forth, right? So these are all traditional industries where your balance sheet is quite large, your asset base is quite large. So to increase your return on assets from, a 4% to, 4.5% even, that small number is actually big in dollar terms. And you can achieve that by being more efficient with technology. So those were the trends that we saw even back in 2017, 2015, and so on, which have come to the fore. COVID, interestingly, has accelerated some of this. It was not a necessity, and it's been obviously a very sad thing for many families and people around the world. But in terms of extra digitalization, I think that's actually brought things forward a bit.
Now, tell us about then the industries that you talked about, because as you said, the baton has been passed, and a lot of times they were probably, even if they were large companies, running on client-server technologies.
Yeah.
So what are some of the low-lying fruits that you see as opportunities? And therefore, that leads me to my next question on the type of businesses, therefore, that you have then funded.
Yeah, we've done a mapping actually. So although I've said that many industries are now adopting technology, obviously each one is on a spectrum. So an industry like agriculture probably is one of the earliest meaning the slowest to adopt, versus there are other industries which have been adopting technology much more rapidly. Banking, for example, telecoms, retail, so on and so forth. So it ranges from industry to industry, quite obviously. Lowest hanging fruit, I think, would depend partly on which industry we're going after, how much digitization that they've actually done. But in addition, it's also about how much, I think you made a very good point, client server, right? Do you have legacy technology that needs to be ripped out or upgraded? Or are you starting from a clean slate? So I think there is no, one simple answer you can actually apply across the board. It really depends on the specifics of the situation. Broadly speaking, I think if you are in an industry where you've really relied a lot on manual work, paper-based processes, or things that move very quickly. Construction is a good example. You might have, 3D drawings put in the computer, and you might have a roster of how your daily activities are going to go. But very quickly, those become out of date. So people have relied on paper in the past. So can you go and say, look, actually, I can still deal with the dynamic nature of your industry, while at the same time, you don't need to rip out whatever you've done in the past. I think those are the kind of opportunities that we're increasingly seeing.
Okay, and then tell us then about your portfolio companies, because that will give us an insight into then how you're executing your thesis.
Yeah.
Give us some ideas of companies that you invested in and the ticket size.
Sure. Our approach is, you could actually summarize it as taking a private equity approach to venture capital. And that's a convoluted way perhaps, or counterintuitive way of saying it. But what it basically means is, it's actually very straightforward. What does private equity do? You have a fund which might be $300, $400, $500 million. You'll have maybe 4 or 5 assets, and you basically own the entire asset, right? Alongside management. We don't go quite that far, but we take a little bit of those elements. What we basically do is we have a concentrated portfolio. So fund 1 had only 7 companies, right? Number 2 is we take fairly chunky ownerships, not majority like the private equity guys do, but much larger than the typical venture capital firm does. Which means, as a corollary of both of these things, fewer companies and higher ownership, we have a lot of influence over those companies, and we can spend time with them. It is not a case that in the typical venture model, you have dozens or even 100 companies in a given fund. Your influence over them is quite little, and your stake is quite small. You don't have the time to spend on them, and so on. We've actually inverted that entire model. So give you a couple of examples. You asked about our prior companies. We have companies which have, I'll name a few of them. There are 7, as I said. I'll just name a couple as examples. One is a company called GlobalTix, which serves the travel industry. So they provide technology for people who run attractions. So this could be large attractions, folks like in Bali, there's a water park called Waterbomb Bali. That's one of their clients. All the way through to long tail, someone running a little kayaking business, someone running maybe a tourist guide business. All of these companies historically have not really used technology very much. So very often they rely on paper-based tickets. Even today, many of these large attractions have people running around with physical tickets going from the attraction through to a travel agent. Can you imagine that in today's world, right? So that's one example. Another example is a company called Zipline. We funded this a few years ago. And this is a great example where taking historical analog processes and digitizing them, number one. But also in this particular case, COVID was a dramatic accelerant for them. They serve the aged care, the senior care facilities, as well as hospitals, okay? Through COVID, and also even prior to that, laws have been changing around the world regarding not just things like, are you compliant with COVID vaccination for people who are walking into a hospital or walking into a senior care center? That's kind of how it got started. But increasingly now, there are compliance issues around, you've got to make all these particular kind of reports in order to receive funding from the government to run your facility, so on and so forth. Each of these activities for your staff to actually run takes up many hours per week, right? And that is not an efficient use of their time. It's not an efficient use of caregivers. such as nurses as an example. It's also not an efficient use of the executives in those companies who actually have day jobs to run. They're not compliance people. So what Zipline does is basically take all that information, make sure that your submissions and your compliance activities are up to date and actually smooth. But number two, and probably even more important, since regulations keep changing nowadays, how do you make sure that you're on top of it? Zipline makes sure that they're on top of it.
And that's interesting because I can see the applications in probably, especially in our region, mature markets like Australia and New Zealand.
Yeah, that's right. So in fact, Zipline happens to be based in Australia. So they've signed up pretty much every major senior care chain in Australia. They've started to enter the hospitals sector. They've done really well there. And not just Australia, we're now going into the US. We've already got our first 10 customers in the US. And the US, I would say California alone is a bigger market than Australia, right? Just that one state. And it certainly helps that with the new administration that has come in, coincidentally, both in Australia as well as in the US, a lot of the laws and compliance regulations have been tightened even further.
And so what are the typical ticket size that you do for each of your investments? Because you take a larger portion, and therefore I would assume that the ticket size is also bigger. And also maybe they're perhaps more mature companies?
Actually, no. These tend to be Series A, right? So we come in by and large at the Series A. We can do slightly before, slightly after, but the median is Series A. So our check sizes historically have been about in the $3 million mark for the first check. We reserve a lot of money for follow-ons. For Fund 2 that we've just launched, the check size maybe will go slightly higher because the fund is going to be larger, but broadly in the same range, right? $3-4 million for your first check. In terms of follow-on, it's not just our capital. We have also LPs who are basically saying, when you find that a future round is too large for the fund to take, please let me know. We would like to co-invest alongside the fund, and we're very happy to entertain those conversations. And lastly, Jeremy in particular, my colleague, who, as I said, had worked in investment banking for many years, he's also a past master at bringing in strategically beneficial investors alongside the fund in later rounds. So we don't take a scattershot approach and just say, look, my company is raising a Series C or whatever it might be. I'll just show it to the whole world, open kimono. Rather, we take a very sort of almost a sniper-like approach, targeted approach to deciding who we should allow into these companies, because we want to bring them valuable partners.
So what you alluded to in the beginning is absolutely spot on. You're really taking a very bespoke and very unusual hybrid approach towards investing in these sort of companies. Really quite untypical for many VCs or PEs, depending on what you are. But Murli, you've been in this game for a while. You've been in this since 2008 in a previous life, and you and Jeremy. What are your thoughts on the Southeast Asian tech investment landscape right now? Because it was running white hot before. And now we're in the middle of a funding winter. What are your thoughts on this?
Yeah. In fact, I did say I've been in ventures since 2008, but actually I've been involved with startups and ventures since the dot-com boom, right? Because I started my career just at the dot-com bust happened. So I've seen at least two historically, and a third one now, in terms of a bit of a slowdown. I'm not 100% sure that funding winter is the correct word to be using, to be honest, okay? The reason I say that is because, yes, it is certainly true that late stage financing has basically ground to a halt, completely true. You look at the public markets, the multiples are all down, right? Completely true. However, early stage, I'm not seeing the same thing, okay? There are good companies out there which are actually potentially fundable and so on. Why this distinction? There's a couple of reasons. One is you are completely correct. It was white hot, until a few months ago, which meant that you also had what I would call tourists entering the space, right? So there were many funders who got into that space who, for them, it's not their day job. They were dabbling. And at some point, when things go different from what they expect, they're very happy to leave, right? We, and I think many of our peers, are not that. We are here to stay, right? This is our core business, right? So late stage financing was driven a lot by, I think, that hot money. And naturally, as you'd expect, some of that also goes away. there's other opportunities for them. They can invest in public markets, if they are liquid shares and so on at much cheaper prices. Why wouldn't you do that, right? Early stage, a bit different. Early stage, I think it takes a little bit of knowledge of what you're investing in. You have to convince entrepreneurs that you're the right partner for them and so on and so forth. So it's not merely throwing in money and saying, go do your work, right? You've got to be a bit more active than that. And I think founders can be very sharp about assessing who's the right partner for them. In many cases, we are the right partner. In a few cases, we ourselves will say, I don't think we're the right partner for you. Please talk to so-and-so. So I think we're honest about that. The other thing is that for early stage financing, we all realize that the holding periods are not sort of buy today, sell tomorrow, right? It is being invested for at least a few years, 3 to 6 to 7, maybe even longer, 9 years could be, within which time the market cycles will sort of go up and down. You can't predict this market cycles. But effectively, what it means is where the market is today almost doesn't matter. It matters, certainly. I'm not saying it does not matter, but it doesn't matter as much as it does for late stage companies who are maybe looking to IPO in 12 months.
Also, one of the things, Murli, is if I could add to what you just said, is the fact that actually there is still a lot of money sloshing around. It's a lot more cautious. And I think, as you said, and I'll use the tourist analogy to also the startups, the lifestyle entrepreneurs who basically started companies to try to basically catch the wave,
yes,
will basically run out of money and die.
That's
the
right.
Survivors, as you and I have seen .com Part 1, the survivors will turn out to be really, really good companies.
That's right. Completely agree. In fact, let's take global tech again as an example, right? As I said, travel software. You can imagine what the pandemic did to them, right? You're in the travel business, selling technology, come on, right? So basically they were shattered, right? Essentially the revenues went to zero. However, since just a couple of months ago, we've actually exceeded the pre-pandemic revenues for this company, right? And that's because, as you very much said, they are here for the long term. They're the survivors. They ran the business so that they knew they could survive the pandemic even for an extra year with no revenues, right? So they're that kind of mindset, survivorship mindset. I think you're completely right that this is true for entrepreneurs in general. There might be tourists among the entrepreneur community. We like to say that we're looking for dreamers and doers, right? It is not just a matter of dreaming. It's not just a matter of doing. You got to have a bit of both. The vision, long-term vision, and being true to it, but also get stuff done.
Yes, absolutely. Now, Murli, you've been in, as you said, you've been in this game for a long time. And obviously with experience also comes the ability to look ahead. What are some key trends and new development that you're seeing in the venture space that we can expect to see perhaps in 2023, 2024?
Yeah, I'm actually not a big fan of predictions. The only thing that's true about predictions is that you don't know what you're talking about, I think. We try to evaluate every business on sort of its individual merits. We don't really have too much of we don't go out and say, look, I want to look for this kind of company in this particular sector at so-and-so valuation because I think this will happen. Very rarely does that ever work, right? Our way of finding companies, we are very fortunate, I would say, that we have a good reputation in the market. Almost all the companies that we meet are inbound referrals or inbound direct approaches to us. We've never had a situation where we've made an investment in a company where we sought out a company because we said we need to be in this space, right? So because of this, we get like several hundred companies per year, right? So more than one company per day is what I'm looking at on average, but we're only investing in 2-3 checks per year, right? So it is our privilege that we are able to learn from a lot of these parties coming in and just apply that knowledge going forward. But does that ever make us the expert, the oracle who can predict the future? I don't think so.
Now, then let me flip the question a little bit. What then, because you have the advantage of, again, as you just said, gaining this knowledge from all these companies, what advice would you give startups now that are looking to get funded?
Yeah, I basically say to startups always, look, how do I evaluate a business? When I evaluate a business, I have to consider basically 2 things. Is there utility in what your business does? Separately, does the market ascribe value to it? right? And those don't necessarily go together. Sometimes when one changes, the other may not change, and they may not change in the same way. You might be doing something very, very valuable, but for whatever reason, external market reasons, interest rates goes up or whatever, your company is worth less, right? So I really tell entrepreneurs, I use the word B2B to mean not business to business, but back to basics. Focus on the basics of your business, right? Make sure you're doing something of value. Don't do it because someone else is doing it. Don't do it because there's money from investors for this. If your customers love you and they pay you money for this, good money, that is a good reason to do it. No other reason is a good reason to do it.
Murli, it's been a fascinating conversation. Any final thoughts you'd like to share with the audience before we end the conversation?
Yeah, I guess I'll just say one final thing, which is around the very first thing that you started with. We are focused on enterprise technology. These are large ticket software companies. We're not selling by and large to companies, to SMEs and so on, right? In general, these are companies which are making high gross margins above 70, sometimes even 80+% with long-term contracts, predictable revenue, so on and so forth. They are very capital efficient, which is also the reason why not much capital flows to them. They don't need it, right? We like this sector because once you're in, we know that we can control our destiny. We know that, all things being equal, it is very hard to kill or to kill off one of these companies. So that's why we like the sector.
Thank you very much for coming on the show.
Thanks, Brian. Much appreciate the opportunity.
Now, we've been speaking to Murli Ravi, the co-founder of Tinman Capital. I'm Brian Fernandez, and this has been BizTech's Investors Conversation Show. This interview will be on our website, www.biztech.asia, as well as our social media platforms. It will also be on our syndication partners, TV stations, radio stations, and websites. Thanks a lot for tuning in.